Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. Today we will be talking about a stock that was pitched in the Barron's newspaper recently as a dividend stock for retirement. That stock is Colgate-Palmolive. Colgate-Palmolive is an American multinational consumer products company. It is the second largest domestic producer of toiletries and other household products. In this video, we will be talking about the company's business by going over its annual report, then review the company's fundamentals by focusing on its key ratios, and finally find the intrinsic value of the company. So let's dive in and review Colgate-Palmolive.
Hey guys, let's start off by looking at the Form 10-K, which is the annual report that Colgate-Palmolive Company filed with the SEC. This is for the fiscal year that ended December 31st, 2021. And on page 3 of this report, the company provides us a general business overview. The company states that it is a caring, innovative growth company reimagining a healthier future for all people, their pets, and our planet. Colgate-Palmolive states that it operates in two product segments. First is the oral, personal, and home care, and second is the pet nutrition segment. The company claims that it is a leader in oral care with global leadership in toothpaste and manual toothbrush categories. It sells its toothpaste under brands such as Colgate, Darlie, elmex, Hello, meridol, Sorriso, and Tom's of Maine. It sells its toothbrushes under brands such as Colgate, Darlie, elmex, and meridol, and its mouthwashes under brands such as Colgate, elmex, and meridol. The company states that its oral care business also includes pharmaceutical products for dentists and other oral health professionals. Colgate believes that it is also a leader in many product categories of personal care market with global leadership in liquid hand soap, which it sells under brands such as Palmolive, Protex, and Softsoap. Its personal care products also includes Irish Spring, Palmolive, and Protex bar soap, as well as shower gels, Lady Speed Stick, Sanex, Speed Stick, and Tom's of Maine deodorant and antiperspirants, EltaMD, Filorga, and PCA SKIN skin health products, and Palmolive shampoos and conditioners. Next, Colgate manufactures and markets a wide array of products for the home care market, including Ajax, Axion, and Palmolive dishwashing liquids, and Ajax, Fabuloso, and Murphy household cleaners. The company is a market leader in fabric conditioners with leading brands including Suavitel in Latin America, Soupline in Europe, and Cuddly in South Pacific. After that, Colgate points out that the sales of its oral, personal, and home care products accounted for 44%, 20%, and 17% respectively of its total worldwide net sales in 2021. Geographically, oral care is a significant part of its business in Asia Pacific, comprising approximately 81% of its net sales in the region for 2021. The second product segment is its Hill's Pet Nutrition segment, also called Hill's or Pet Nutrition. The company believes that it is a world leader in specialty pet nutrition products for cats and dogs, with products marketed in over 80 countries and territories worldwide. Now let's go to page 116 of this report, where the company provides us more information about these segments. Colgate states that approximately 70% of the company's net sales are generated from markets outside of the United States, with approximately 45% of the company's net sales coming from emerging markets. These emerging markets consist of Latin America, Asia, excluding Japan, Africa, Eurasia, and Central Europe. Next, Colgate points out that its oral, personal, and home care sales to Walmart and its affiliates represented approximately 12%, 12%, and 11% of the company's net sales in 2021, 2020, and 2019, respectively. In short, Colgate has a big exposure to the international market, and it is dependent on one single customer, that is Walmart, for more than 10% of its revenue. Next, Colgate breaks down its net sales based on the two reportable segments and its geographic regions. For the year 2021, the total oral, personal, and home care sales amounted to about $14 billion. Pet nutrition amounted to about $3.3 billion, and the company had a total net sales of about $17.4 billion. When we look at the geographic regions and their sales in 2021 and compare those to 2020, we can see that other than North America, all the other geographic regions saw an increase in their sales numbers. The reason that the company gave for the lower sales numbers in North America was because it increased its prices, and that led to a lower sales volume, which is the reason why North America saw a drop in sales in the year 2021. The company's pet nutrition segment has seen a growth in its sales every year for the past 3 years, and its total net sales have also been trending upwards. On the next page, Colgate breaks down its operating profit numbers. For the year 2021, the company's total operating profit amounted to about $3.3 billion. North America's operating profit was about $754 million, and Latin America's operating profit was about $1 billion. As we saw on the previous page, both North America and Latin America have fairly equal sales numbers. However, Latin America has a higher operating profit number. This tells us that the operations in Latin America are more profitable. Said differently, Latin America has a higher operating profit margin than North America. Next is the capital expenditure. For the year 2021, the total oral, personal, and healthcare capex amounted to about $332 million, out of which a third of it went towards Latin America. This makes sense because majority of the company's operating profit came from Latin America, so we expect the company to invest heavily in regions that are the most profitable. Now that we have a brief understanding of Colgate's business, its two reportable segments, and its revenue breakdown, let's review the company's fundamentals by focusing on its key ratios. Hey guys, I'm on Morningstar looking at Colgate-Palmolive Company. Under key ratios, we have the financials. The first item on the list is the revenue. The revenue is the top line of the income statement. This is the amount of money that the company brings in via sales. Back in 2012, the company's revenue was about $17 billion. And over the next few years, the company's revenue saw a decline. That is, back in 2016, the company's revenue dropped down to about $15 billion. And ever since then, the company's revenue has been trending upwards. And for the trailing 12 months, that number was about $17.4 billion. Next is the operating income. The operating income is the amount of money that's left with the company once we subtract the cost of goods and operating expenses from the company's revenue. Back in 2012, the company's operating income was about $3.972 billion. And for the trailing 12 months, that number was about $3.901 billion. Over the past 10 years, the company's operating income has hovered between a low of about $3.6 billion to a high of about $4.1 billion. Next is the operating margin. The operating margin is the ratio of the company's operating income to its revenue. So it gives an idea of how much money is left with the company once it pays for the cost of goods and operating expenses. Back in 2012, the company's operating margin was about 23.2%. And for the trailing 12 months, that number was about 22.4%. What this means is every $100 that the company made in sales, by the time it paid for its cost of goods and operating expenses, it had $22.4 left. Ideally, we want to see the company's operating margin to be staying steady or increasing, and Colgate's operating margin has stayed fairly consistent over the past 10 years. Next is the net income. The net income is the bottom line of the income statement. This is the amount of money that's left with the company once it pays for the cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes. Back in 2012, the company's net income was about $2.5 billion, and for the trailing 12 months, that number was about $2.2 billion. Over the past 10 years, the company's net income has stayed fairly consistent. It has always been positive, which shows us that the company has always reported a profit. Ideally, we want to see the company's net income, operating income, and revenue to have a similar trend. That is, we want these numbers to be positive, staying steady, or increasing. Next is the dividends per share. Back in 2012, the company paid out about $1.22 per share as dividend. And for the trailing 12 months, that number was about $1.79 per share as dividend. Colgate has not only paid out consistent dividend, but it has also hiked its dividend every year for the past 60 years. After that, looking at the shares outstanding, back in 2012, the company had 960 million shares outstanding. And for the trailing 12 months, that number has decreased to 848 million shares outstanding. We can see that Colgate has been buying back its shares every year for the past 10 years. This is good news for existing shareholders because when a company buys back its shares, it actually helps increase the existing shareholders' ownership within the company. The way Colgate pays out its dividends and the way it buys back its shares indicates that the management is shareholder friendly. Next is the book value per share. The book value is what we get when we subtract the company's total liabilities from its total assets. In other words, book value is the same as shareholders' equity. Back in 2012, the company's book value was about $2.34 per share, and for the trailing 12 months, that number was about $0.72 per share. Over the past 10 years, there were a few years when the company's book value per share was negative, and even today, the company's book value per share is a lot lower than its current stock price. These low book value per share numbers are due to the fact that the company buys back a lot of its shares. When a company buys back its shares, it uses up its assets, its cash, in order to buy back its shares, which drives down the company's equity portion on the balance sheet, and hence we see these low book value per share numbers. In reality, we know that Colgate is making money, it is profitable, and after a company buys back its shares, the existing shareholders have a bigger ownership of the company. In short, these low book value per share numbers are due to the company's share repurchase program. Finally, looking at the free cash flow. The free cash flow is what we get when we subtract the company's capital spending from its operating cash flow. Back in 2012, the company's free cash flow was about $2.6 billion. And for the year 2021, it was about $2.758 billion. Colgate's free cash flow over the past 10 years has always been positive, which tells us that its operating cash flow exceeded its capital spending. I will be using the 2021 free cash flow number of $2,758 million for my discounted free cash flow DCF analysis. Now let's look at the profitability of the company, focusing on the net margin. The net margin is the ratio of the company's bottom line to its top line, so it compares the company's net income to its revenue. Back in 2012, the company's net margin was about 14.47%, and for the trailing 12 months, that number was 12.43%. What this means is every $100 that the company made in sales over the past 12 months, By the time it paid for its cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes, it had $12.43 left as pure profit. Ideally, we want the company's net margin numbers to be positive, staying steady, or increasing. Next is the return on equity. The return on equity is the ratio of the company's income to its shareholders' equity. Warren Buffett prefers to only invest in securities that have a return on equity of 8% or greater every year for the past 10 years. These highly inflated return on equity numbers are due to the company's share buyback program. So when a company buys back its shares, it decreases the equity portion on the balance sheet. So when we compare an income to a tiny equity portion, we're bound to get inflated return on equity numbers. Next is the return on invested capital. This number gives an idea of how good the management is at allocating the company's capital and getting a return on that investment. Back in 2012, the company's return on invested capital was about 34%, and for the trailing 12 months, that number was about 26.42%. Colgate's weighted average cost of capital, also known as the company's hurdle rate, is about 5.21%, and since the company's return on invested capital is greater than its weighted average cost of capital, we can safely say that the management is creating value for its shareholders. Finally, looking at the interest coverage is the ratio of the company's income to its interest obligations. So it gives an idea of how many times can the company pay off its interest using its income in that calendar year. Back in 2012, the company's interest coverage was about 49 times, and for the trailing 12 months, that number was about 17 times. Benjamin Graham, the father of value investing, preferred to only invest in securities that had interest coverage of 5 times or higher. Now let's look at the financial health and liquidity ratios. The first item on the list is the current ratio. The current ratio compares the company's current assets to its current liabilities. Ideally, we want the company's current ratio to be greater than 1.0, as that tells us that the company has enough assets to fulfill its liabilities over the next 12 months. Back in 2012, the company's current ratio was at 1.22, and for the latest quarter, it's at 1.09. Next is the quick ratio. The quick ratio is similar to the current ratio except we disregard the inventory component. In other words, quick ratio is equal to current assets minus inventory divided by current liabilities. A quick ratio greater than 1.0 tells us that the company does not have to rely on selling its inventory in order to fulfill its current liabilities. Back in 2012, the company's quick ratio was at 0.68, and for the latest quarter, it's at 0.53. Next is the financial leverage. The financial leverage is the ratio of the company's total assets to shareholders' equity. A financial leverage of 1.0 tells us that all of the company's assets are financed via shareholders' equity. A financial leverage of 2.0 tells us that half of the company's assets are financed via liabilities and half of them are financed via shareholders' equity. Back in 2012, the company's financial leverage was at 6.12, and for the latest quarter, it's at 24.70. Finally, looking at the debt-to-equity ratio, this ratio compares the company's total debt to its shareholders' equity. Ideally, we want the company's debt-to-equity ratio to be less than 1.0. Back in 2012, the company's debt-to-equity was at 2.25, and for the latest quarter, it's at 12.55. These high financial leverage and debt-to-equity ratios are primarily due to the fact that the company has tiny equity portion, which is a result of share buybacks. Now let's look at the efficiency ratios. The first item on the list is the day sales outstanding. This number gives an idea of how many days go by from the day the company recognizes its sale to the day it actually receives cash for that service rendered. Back in 2012, the company's day sales outstanding was about 36 days, and for the trailing 12 months, that number was about 27 days. Ideally, we want the company's day sales outstanding number to be staying steady or decreasing. What we do not want to see is a company whose day sales outstanding number is growing rapidly, as that tells us that the company's management is being aggressive with its accounting, as it's trying to recognize its revenue sooner so that it can inflate its income numbers on its income statement. However, Colgate's management does not appear to be playing any such accounting tricks, as its day sales outstanding number has slowly been trending downwards. Next is the days inventory. This number gives an idea of how many days does the company's products sit in its inventory before they're sold. Ideally, we want the company's days inventory number to be staying steady or decreasing. Back in 2012, the company's days inventory was about 69 days, and for the trailing 12 months, that number was about 87 days. The company's days inventory has been trending upwards since 2015, and that is not a trend that we want to see. However, it's not growing at a rapid pace where it's a cause of concern that the company may have an inventory glut. Finally, looking at the payables period, this number gives an idea of how many days does the company take to pay its suppliers. Back in 2012, the company took about 65 days to pay its suppliers, and for the trailing 12 months, that number was about 74 days. Ideally, we want the company's payables period to be staying steady or decreasing. What we do not want to see is a company whose payables period is growing rapidly, as that tells us that the company's management may be holding on to its cash in order to artificially inflate its cash flow numbers. Similar to the company's days inventory, the company's payables period has been trending upwards since 2015. However, it's not growing at a rapid pace where it's a cause of concern, but certainly something to keep an eye on. Now let's look at the company's current valuation. The first item on the list is the price to earnings ratio. Colgate has a PE of 29.3. It has a price to book of 103.2. The company has a price to sales of 3.6. It has a price to cash flow of 19.1 and finally has a dividend yield of 2.4%. This inflated price to book ratio is driven by the fact that the company has tiny equity portion resulting from the share buybacks. When we compare Colgate's current valuation to its 5-year average, we can see that on all the valuation metrics other than the price to earnings ratio, Colgate is undervalued right now than its 5-year average. Now let's look at Colgate-Palmolive's discounted free cash flow DCF analysis. Over here I pasted the company's 2021 free cash flow number that I got from Morningstar, which was $2,758 million. I'm assuming that the company's free cash flow will grow at 7% every year for the next 10 years. I'm using a discount rate of 10%. What this means is I want this investment to give me a 10% return. In other words, I want to double my investment in about 7 years. I'm assuming the company's long-term growth rate to be 2.6%. This number is in line with the current 30-year US Treasury yield. Colgate has 848 million shares outstanding and has a long-term debt of $7,194 million. I got this number from the company's balance sheet. After taking all of these inputs into account, we get the company's intrinsic value to be about $52.81 per share. And when we compare this intrinsic value to the company's current stock price, which is about $74.78 per share, we can see that the company's current stock is trading about 1.4 times its intrinsic value. The way we calculate this intrinsic value is if we look at what the free cash flows would be every year for the next 10 years, we sum up all those free cash flows, which come out to about $24 billion. Then we look at what the free cash flows would be after the 10-year mark into perpetuity. We sum all those up to get the intrinsic value to be about $52 billion. From this number, we subtract the long-term debt and divide by the shares outstanding to get the intrinsic value per share to be about $53. If we disregard the perpetuity component, in other words, if you think that Colgate is only going to grow for the next 10 years and then it'll cease to exist, then we get the intrinsic value without the perpetuity to be about $20 per share. And if we disregard the debt, in other words, if you think that Colgate is going to grow into perpetuity, so there's no point for us to worry about the company paying off its debt, then we get the intrinsic value without the debt to be about $61 per share. Finally, let's try to figure out what kind of return can we expect to get on this investment if we were to invest in the security at the current stock price. For that, I will set my sell to the intrinsic value. My to value is going to be the current stock price, which is $74.78 per share. And I will run this analysis by changing the company's discount rate. What I get is if I were to invest in the security at the current stock price of about $74.78 per share, I can expect to get an annual return of about 8.2% on this investment. Overall, Colgate has good fundamentals. Some of its ratios were deceiving due to the excessive buybacks that the company has done in the past and is still doing. When a company buys back its shares, it decreases the equity portion on the balance sheet, which leads to inflated return on equity numbers, high financial leverage, high debt to equity ratios, and low book value per share numbers. However, in reality, the company has reported a profit every year for the past 10 years, and its free cash flows have been positive every year for the past 10 years. Colgate began its 2022 Global Productivity Initiative this year, where it plans to increase its operating efficiencies, simplify its supply chain, and turn to higher margin offerings to drive savings. Additionally, Colgate is experiencing inflationary pressures associated with its production costs, and due to its defensive nature, Colgate is likely going to be able to pass on those inflationary pressures to the end consumer. Lastly, Colgate makes majority of its money from international markets, especially emerging markets, and if there is a downturn in any international economies, Colgate's revenue, despite its defensive nature, is likely going to suffer. Hey guys, that is all I had for you this week. Hopefully you found this video on Colgate-Palmolive interesting. If you like this content, please do like, share, comment, and subscribe. And if you have any suggestions on which stock I should review next, please leave it in the comment section below. I'll greatly appreciate it. Thank you.